So if we finished, did we were to start on that question or we finished? We finished November 2018. Yeah, so we shall do one more other question. I want us to check one more other question on that bit before we conclude that area. So the next question I would like us now to go through. Check November 2016, question number 5, part C. We now go to November 2016, question 5, part C. So we now go to November 2016, question 5C. Question number 5, part C. So we go to November 2016, question number 5, part C. November 2016, question number 5, part C. So you can see the question. So that question for November 2016, question 5C, the question was able to read that the following data was extracted from the financial statement for the year ended 30th June 2016, for the year ended 30th September 2016. So they were able to give you the total sales, then variable cost, then contribution, then fixed cost, earnings before interest and tax, then the interest, then profit before the tax, then the profit before the tax. So required, using the concept of leverage, they would like you to determine from letter 1, percentage taxable income if the earnings before interest and tax increase by 6%. From letter 2, the percentage earnings before interest and tax if there is a 10% increase in the sales. Then Roman letter 3, the percentage taxable income if the sales were to increase by 8%. So that question is still on leverage, but now they have specified. You can either do it manually or you can calculate using the leverage concept. So what I would like you now to remember is to know how to calculate the leverage. Like now from that question, there are some formulas I want us to clarify. There are some formulas I would like us to clarify on how to apply them when it comes to leverage, the leverage part of it. So what we need to do at that point, when you remember how to calculate the degree. So degree of operating leverage, remember it was Q then P minus P divided by Q, then P minus P, then minus F. So when you open the brackets, this is the same as QP. Then then you minus QB. We do the same, QB minus QB minus F, like that. So what I'm trying to show is to let you know from that question, QP is the cells. QP is the same as the cells. Then QB is the variable cost. So when you look at that question, they gave you the income statement. When you take the cells minus the variable cost, you come up with the contribution. So which means that the degree of operating leverage can also be given by contribution, can also be given by the contribution like that. From that income statement, when you take the sales minus the variable cost, that difference will give you the contribution. Also, when you look at that statement, when you take the sales, you minus the variable cost, you minus the fixed cost. That item is the same as earnings before interest and tax. So also to get the degree of operating leverage, it is simply a contribution, then you divide by earnings before interest and tax. So this is another formula on how to calculate the degree of operating leverage. It is another formula on how to compute the degree of operating leverage. Then also, if you also remember the degree of financial leverage. Degree of financial leverage, it was also meant to be QP minus QB minus F. Also QP, I've just opened the brackets. QB minus F, subtract interest. Then also subtract the preference dividends. Then you divide by 1 minus the tax rate. So this QP minus QP minus F. Sorry. I've just left the next start of the class. To confirm value from. Maybe she has one. Sorry, that's something. So you can see this particular numerator, it is the same as earnings before interest and tax. When you take the sales minus the variable cost minus the fixed cost, it is the same as earnings before interest and the tax. Then the denominator, if there is no preference dividend, this part is the same as earnings before the tax. So that's now how we can also compute the degree of financial leverage. So degree of operating leverage can also be given by contribution divided by the earnings before interest and tax. Then also the degree of financial leverage can be given by earnings before interest and tax. Then we divide by earnings before the tax. That's now another format on how you can compute them. So when you go back to the question, using the concept of leverage, that Roman letter 1, the percentage taxable income, if the earnings before interest and tax increase by 6%. So you can see that Roman letter 1, it has an item of, so taxable income is the same as the earnings before the tax. Taxable income is the same as the earnings before the tax. Then earnings before interest and tax in that element. So that means that Roman letter 1, we use the degree of financial leverage. That Roman letter 1, we shall apply the degree of financial leverage. We apply the degree of financial leverage because degree of financial leverage is also the same as earnings before interest and tax divided by earnings before the tax, as per this formula I've shown you. So in that Roman letter 1, they are asking that the percentage taxable income. So taxable income is the same as earnings before the tax. The percentage taxable income, if the earnings before interest and tax will increase by 6%. So that Roman letter 1, we shall first calculate the degree of financial leverage. We shall first calculate the degree of financial leverage. Then from there, we make the decision. So to get our degree of financial leverage in that question, our earnings before interest and tax has been given as 600,000. Then we divide by earnings before the tax. It's the same as the profit before the tax. We divide by 525. 525 like that. So when you compute that part, it should be able to give you which figure? When you take 600,000 divided by 252,000, it should be able to give us which figure? Someone who can compute and then you give me the value. Sorry? So I can see 1.142. I can see 1.142 like that. So that's now the degree of financial leverage. Then now after that, we can now comment that, we can now write something brief on that by noting that if the earnings before interest and tax, if the earnings before interest and tax, if the earnings before interest and tax increase by 6%, if the earnings before interest and tax increase by 6%, then the earnings before the tax or the taxable income, then the earnings before the tax or the taxable income will increase by, it will increase by, so you simply take 1.142 multiplied by 6% like that. You simply take 1.142 and multiplied by 6%. So when you take 1.142 multiplied by 6, it should be able to give us which value? So when you multiply, it should be able to give us which value? So you are going to get 6.86. You are going to get 6.86 as a percentage. 6.86% like that. So that's now when you use the degree of leverage. Remember, you multiplied by, it must be in form of a percentage. So and you multiply by 100. It must be in the form of the percentage. The question wanted the percentage taxable income. So you show it as a percentage. So as a percentage, it will be 6.86. So that is when you use the concept of leverage. But still, we can do without leverage. We can still get the same without leverage. Without leverage. So if it is without leverage, if it is without leverage, we simply check in the question. So we are doing the question for the sitting of November. So that question that we are dealing with, the question is meant to be November 2016. November 2016, it is question number 5, part C. November 2016, question 5C. November 2016, question 5C. So when we are not using the concept of leverage, we check in the question what they have given you as earnings, because they are saying that if the earnings before interest and tax was to increase by 6%. So earnings before interest and tax, when it increased by 6%, we get 106%. 106% of the 600,000 of the 600,000. So confirm to me, when you take 106% of 600,000, it will be how much? So you get 636,000. 636,000. So that's now what you are given. That will be. Then now we less interest. We less interest. We minus interest. So interest in that question is 75,000. It is meant to be 75,000. So when you minus 75,000, what will be the earnings before? Earnings before the tax. What will be that figure of the earnings before the tax? When you take 636 minus 75,000, what should be the earnings before the tax? 561. 561. Yeah. So we are simply confirming that you can still get this one. So when you do it, this one was using the leverage. So what the question has given, so the percentage earnings before tax. So you just take what we have calculated as 561 minus what was initially there. You subtract what was initially there. You see what was initially there in the question? It was 525. It was 525,000. So also divide by the 525. Then express it as a percentage. So when you express it as a percentage, it will be what percentage? So also take this, divide by that. Yeah, it is still meant to be 6.8. Yeah, so it is the same thing. Yeah, nataka muandike this information so that we proceed. Those who have just joined, can you write all that information before now we continue? Yes, Roman letter 1. Yes. So those who have just joined in, we have finished the Roman letter 1 of that question. But first, I want you to copy this information because it is part of the notes. Then from there, we now proceed. From there, now proceed. So, have we finished copying? So, have we finished? Mmemaliza nyinyi? Yes.
After the increase, then you remove the deductible income, which is 561. So how get the percentage now?
Not after the increase from where it was up to, then divide by the base. The base is normally what was initially there. Mananga is a percentage change. To get the percentage change, take the increase, divide by what was there originally. Yeah. To know it has increased by what percent. Yeah. So to know the value at which it has gone up by in form of the percentage, get the increase, so you can find your increase, then divide by what was originally there in full. Yeah. Then now get it as a percentage. So it will tell you when you increase earnings before interest and tax by 6%, earnings before tax will go up by 6.86%. That's now what is meant to be the explanation. So upper, it is without leverage, but here is with the leverage. So this one up here. This is with the leverage, here without leverage. Because the question had said that using the concept of leverage. So using the concept of leverage, you take the degree of financial leverage. Then you increase that figure by 6%, then you will get the value for that. But without leverage, now you do it manually because they have explained. So this is just a confirmation that this is what was the increase. So next time, talk with the class mapema. So next time, talk with the class mapema. Because my father will explain. You see where I started? And I explained all that. So I was only now doing the question because I had explained the entire question before I started. So that is now the Roman letter 1. the percentage taxable income. So taxable income is also the same as earnings before interest and tax. Then from these formulas, I've also indicated for you that to get a degree of operating leverage, instead of this part, you can also use this. The reason why you can use this, you can see the income statement, the question that has given you. So you see the total sales, then minus variable cost, you get what? Contribution. So total sales is when you open the brackets. QP is the same as the sales. Minus QB is the same as variable, or the difference is the same as contribution. So also to calculate the degree of financial leverage, instead of using this part, you just take the contribution, then this denominator, when you check through the question, you see you take the total sales minus variable cost, you get contribution, isn't it? Then you minus the fixed cost. It's the same thing that is here under the denominator. It's the same as earnings before the tax. That's now how to get the degree of operating leverage. When it comes to the degree of financial leverage, you repeat the same. The numerator is the same as earnings before the tax. Then the denominator, when you look at that question, because there was no preference dividend, is the denominator is the same as earned profit before the tax. So this is another formula of how to get the degree of financial leverage. Also, that's another formula on how to get the degree of operating leverage as per that question. So we have finished the Roman letter 1. Let us now go to the Roman letter 2. Roman letter 2 is about the percentage earnings before interest and tax. If the sales increase by 10%, if the sales increase by 10%. So if you check the first formula I gave you for the degree of operating leverage, remember the first formula I gave you for the degree of operating leverage? It was percentage change in our last class. It was percentage change in degree of operating leverage. I gave you two formulas for the degree of operating leverage. The first one was the percentage change in earnings before interest and tax as a result of the percentage change in sales. So it is the same explanation which is given. You see that from letter 2, they are mentioning about the earnings before interest and tax if the sales increase by what percent? 10%. So you are advised to use the degree of operating leverage, because the degree of operating leverage among the formulas I gave you, it was percentage change in the earnings before interest and tax divided by the percentage change in sales, which is the same information given in the Roman letter 2. The earnings before interest and tax and also the sales. That is what will advise me now in the Roman letter 2 to use the degree of operating leverage. Yeah.
And how did you know that in Roman 1 you're supposed to do financial leverage?
Yeah, well, maybe explain from this one here. So now how to get the degree of financial leverage. The same as earnings before interest and tax divided by what? Earnings before the tax. So when you look at the question, they have asked you that the percentage taxable income. So taxable income here. Earnings before the tax. Then as a result of increase in what? Earnings before interest and tax. Yeah, so this part is what is explaining why Roman letter 1 have picked the degree of financial leverage, but Roman letter 2 are picking what? The degree of operating leverage. So you have to read the notes and understand those formulas. Then now when it comes to the interpretation, once they ask a given item against the other item, you can know it is applicable under which formula. Yeah, so that Roman letter 2, we are using the degree of operating leverage. We use the degree of operating leverage. So the Roman letter 3, we use Roman letter 2. Use the degree of operating leverage. We use the degree of operating leverage. Apply the degree of operating leverage. So to get the degree of operating leverage, So degree of operating leverage, it is given by the contribution, divided by the earnings before interest after tax. So now to get the degree of operating leverage, we should come up with that information. So the contribution in the question is 1.2 million. It is meant to be 1.2 million. Then earnings before interest and tax, it is 600. It's given as 600. So when you compute, you should be able to switch. So when you take 2.1 divided by 600, 3.5. Yeah, it will be able to give you 3.5. Able to give us 3.5. So after getting the 3.5, we can add there a paragraph by noting that. We can now add there a paragraph by noting that if the sales increase by 10%, if the sales increase by 10%, then earnings before interest and tax, will increase by, then the earnings before interest and tax will increase by, so just take the 3.5 multiplied by 10%, which will be the same as 35%. So 3.5 multiplied by 10%, which is the same as 35%. That's now the concept of leverage. But I can also do it without the concept of leverage. Let us now do the same without leverage. So this is now without leverage. When there is no leverage, what you need to do first is to calculate the variable cost ratio. You need first to calculate the variable cost ratio. Variable cost ratio, if you remember, it was B divided by B. But now we don't have B and B. What you need to do, we use total variable cost, also total sales, like that. So instead of variable cost per unit, we use the total variable cost. Instead of the selling price per unit, use the total sales. So in that question, they have already given you the variable cost. Are you able to see the variable cost? It is 0.9 millions. Then sales is 3 millions, like that. So when you compute that, variable cost ratio should be the same as it here. 0.3. Exactly 0.3. It is exactly 0.3. And then now after that, because we want to see that particular earnings before interest and tax will increase by what value. So we now prepare the income statement afresh. So we start with the sales. We start off with the sales. So that sales has gone up by 10%. So get 110%. 110% of 3 millions. We get 110% of 3 millions. 3.3. So 3.3 million. So we less the variable cost. We minus variable cost. So variable cost, use that variable cost ratio multiply the new value of the sales. So variable cost, you just take the 0.3 multiply 3.3 because will be in the same proportion as the increase in the sales. 9.9. So when you subtract, we now get the contraction. We now get the contribution. Itakuwa negative. C ni 0.9. So ni 0.9. 2.1. Then now we less the fixed cost. So fixed cost they are never affected. Now there's the fixed cost. So fixed cost was which figure? 1.5. So you subtract 1.5 million, so that we get the earnings before the interest and tax. Earnings before interest and tax. 0.81. Sasa hiyo ndio tulikuwa tunatafuta. So what is the percentage increase in that figure? So to get the percentage increase, to get now the percentage increase, we just take what we have calculated at 0.18. Sorry, 0.81, not 0.81. Minus what was initially there. You see what was initially there? It was 600. So that's the same as 0.6. So you minus 0.6, also divide by 0.6, and express it as a percentage to see whether you get the same figure of 35%. So that one is without leverage, but the other one was with leverage. So, yeah, so I'm just confirming the same answer we calculate. So the other one was using the concept of leverage, but this one is without leverage. So you want to use the first part, but now I'm showing you to confirm that whether you use leverage or the other option is still give you the same. So we go now to the Roman letter 3. Roman letter 3, percentage taxable income if the sales were to increase by what percent? 8%. So that is now obvious degree of combined leverage. That's now obvious the degree of the combined leverage or total leverage. Degree of combined leverage or total leverage. So there is a formula I gave you about the degree of combined leverage. So to get the degree of combined leverage or total leverage, so degree of the combined leverage or total leverage. So degree of the combined leverage or total leverage. So degree of the combined leverage. Just take the degree of operating leverage over the degree of financial leverage. So degree for the operating leverage, so this 3 point was, you require 3.5. Now you can require 1 point. 1. Oh, sorry. So when you round off, it's just 4, isn't it? Sometimes also the degree of combined leverage, degree of the combined leverage can also be given by contribution, and divided by earnings before the tax. It can also be given by the contribution divided by earnings before the tax. So contribution is given as what in the question. Can you confirm for me the contribution? 2.1. 2.1 So we divide by earnings before the tax is the same as which figure with the profit before the tax. So that's the same as 0.525. So confirm that it is the same as which bar. Yeah, so this is also another formula of how to calculate the degree of combined leverage. So this is from the income statement perspective. Yeah. But the other one is now. So now we can make a conclusion on the same by now noting that we can now add there a paragraph by summarizing that. Therefore, if the sales increase by 8%, therefore, if the sales increase by 8%, if the sales increase by 8%, then taxable income will increase by, will increase by 4 multiplied by 8%. So 4 is the degree of combined leverage. Then 8% is given in the question. 8% is given to the question. So it will be the same as 32%. It will be the same as 32%. So that's now the conclusion for that was the last question. In the last class, we did how many? We did 2 questions. The last class I suspect we did 2, isn't it? Yeah, so that's a tatu. So those 3 questions are enough to assist you about leverage. So we have done now the 3 questions on the leverage. So I want us now to have a new subtopic. So a new topic or subtopic, we can now look at working capital operating cycle. We can now have working capital operating cycle, and cash conversion or operating cycle, cash conversion or operating cycle. We can now write something about the working capital operating cycle, or simply the cash conversion or operating cycle. So both of them are simply the length of time to recover your initial amount invested. All of them are the length of time to recover the initial amount invested. So the other one will be in the stock, this other one will be in the finished goods. So we can write something brief by noting that working capital operating cycle. Working capital operating cycle. The working capital operating cycle is the length of time taken. It is the length of time taken, to convert an item of the working capital, from one stage to another, to convert the item of the working capital from one stage to another, in the process of generating cash. From one stage to another in the process of generating cash. Then another paragraph, not that cash conversion or operating cycle. The cash conversion or operating cycle. The cash conversion or operating cycle is the length of time it takes. It is the length of time it takes. The length of time it takes from the time cash is converted into stock. From the time cash is converted into stock of the raw materials. Cash is converted into the stock of the raw materials or finished goods. Cash is converted into the stock of the raw materials or finished goods up to the time it is recovered back. Up to the time it is recovered back. Up to the time it is recovered back as cash. Up to the time it is recovered back as cash. Then we continue by noting that a new paragraph. The major aim of determining the cash conversion cycle is two. The major aim of determining the cash conversion cycle is to number one is that to assess the amount of the working capital required. To assess the amount of the working capital required. To assess the amount of the working capital required during the period cash is tied up. During the period cash is tied up in the working capital items. Cash is tied up in the working capital items. Cash is tied up in the working capital items. Number two is that to assess the performance of the company. To assess the performance of the company. To assess the performance of the company in the area of debtors collection period. In the area of the debtors collection period and creditors payment period. Debtors collection period and the creditors payment period. And the creditors payment period. And the creditors payment period. The number three is that to determine the performance of the management. To determine the performance of the management. To determine the performance of the management in the working capital management. To determine the performance of the management in the working capital management. The working capital management. Then now another paragraph, we note that the operating cycle is classified into two categories. The operating cycle is classified into two categories. The operating cycle is classified into two categories. It is classified into two categories depending on the nature of the industry. Depending on the nature of the industry. Depending on the nature of the industry where the company is operating. Depending on the nature of the industry where the company is operating as follows. Depending on the nature of the industry where the company is operating as follows. Where the company is operating as follows. So Roman letter one will be non-manufacturing firms. Non-manufacturing firms. Number one is non-manufacturing firms. Number 2 would be manufacturing firms. Number 2 would be manufacturing firms. So we start off with non-manufacturing firms. We start off with the non-manufacturing firms. Non-manufacturing firms. So under the non-manufacturing firms, we note that in this case, the operating cycle, will take into account. In this case, the operating cycle will take into account. The operating cycle will take into account. Stock turnover in days. We take into account the stock turnover in days. The stock turnover in days, comma, debtors collection period in days. The debtors collection period in days. The debtors collection period in days. And creditors payment period in days. And the creditors payment period in days. And the creditors payment period in days. So I'll now give you the formula on how to get those items. So working capital operating cycle, working capital operating cycle is supposed to be given by stock turnover in days. Stock turnover in days. Then you add debtors collection in days. Debtors collection So working capital operating cycle, you simply take the stock turnover in days, then you add debtors collection period in days, the debtors collection period in days. Then also to compute the cash conversion or operating cycle. Cash conversion or operating cycle. It is supposed to be given by the stock turnover in days. The stock turnover days. And then we add debtors collection days. Debtors collection then we subtract the creditors payment period. Creditors payment period. So when you want also to calculate now the cash conversion or operating cycle, that one is given by the stock turnover in days plus the debtors collection period in days, but now subtract the creditors payment period in. It's the same thing, but now you minus the creditors payment. So that's now how we shall be coming up with the cash operating cycle. The working capital operating cycle is simply the stock turnover plus what? The debtors collection. So that's now the information we can have for that level. So we can now check a question in your past papers. November 2011, question 1, part C. November 2011, question number 1 was November 2011, question number 1 was November 2011, question number 1, part C. So we can check November 2011, question number 1, part C. So the question reads that. It should be June 2011. Should be June 2011. It should be June 2011. Question number 1, part C. June 2011. Question number 1, part C. So mine is page 87. I don't know on your side. There is June 2011 somewhere. June 2011, question number 1, part C. So, June 2011, question 1C. The question reads that you are given the following financial statement. You are given the following financial statement information for Motor Limited. For Motor Limited, for the year ended 31st December 2010. For the year ended 31st December 2010. So they gave you the item, then beginning and also ending. They gave you the items, beginning and also ending. So they gave you the inventory, accounts receivable, accounts payable, and also the net sales. Then you are also given the cost of goods sold. So required the operating and cash conversion cycle, assuming there are how many days in a year? So that should be reading that working capital operating cycle and the cash conversion cycle. So there was a mistake in typing. So it should be the working capital operating cycle and the cash conversion cycle, assuming the year has got how many days? 360 days. Assuming the year has 360 days. So we shall first calculate those 3 questions, then you answer the question. So what we do, we shall have it arranged. So you will be having the column for the ratio. We shall be having the column for the ratio. We shall have the ratio. Then the formula we shall be able to apply. Then the calculation. Finally, we shall do some calculation at that point. So the ratio, we shall use the formula, and then we come up with the calculation for that. So the first ratio will be stock turnover in days. So the first one will be the stock turnover. The stock turnover. So to get the stock turnover in days, stock turnover in days will be equal to number of days in a year. Number of days in a year multiplied by the average stock of the finished goods. Average stock of the finished goods. We divide by the cost of sales. We divide by the cost of sales. So simply take number of days in a year, multiply the average stock of the finished goods, divide by the cost of sales. Divide by the cost of sales. So number of days, they say we assume there are how many days in a year? we assume there are 360 days in a year. So it will be 360 multiplied. So stock there is the inventory. So average, you take the beginning plus the ending divided by 2. So you take 17,314, you add 15,960, then divide by 2. Then cost of sales was given to you. Cost of sales was given to you as 92,000. As 92,000. So you can round it off to 2 decimal places. Round it off into 2 decimal places. So inventory is our stock of the finished goods. Yeah, so that's now our stock turnover days. So the second one is supposed to be debtors collection period days. Debtors collection period in days. Debtors collection period in days. So debtors collection period in days will also be given by number of days in a year. Number of days in a year multiplied by average. Multiplied by the average debtors. Multiplied by the average debtors. We divide by the credit sales. Divide by the credit sales. Divide by the credit sales. So debtors collection period in days will be given by number of days in a year multiplied by the average debtors divided by the credit sales. So number of days in a year are 360. So debtors are the same as accounts receivable. So you get the average for that. So 42 to 40. Then we add 37 to 50 by 2. Then credit sales, we assume all the sales are on credit. We assume that all the sales were on credit, which was 120. Which was 120. So after that one is giving you how many days? 119.24. And then the last one is the creditors payment period. Number 3 should be the creditors payment period in days. So to get the creditors payment period in days, it is supposed to be given by number of days in a year. Number of days in a year multiplied by average creditors. Average creditors. Average creditors. Then you divide by credit purchases. Divide by the credit purchases. Divide by the credit purchases. So it is 360 multiplied by, so average creditors are the same as the accounts payable. So you take 35, 5, 10 plus 27, 17 divided by 2. So credit purchases was not given. We should calculate the purchases. So purchases we compute. So to get the purchases, when you want to calculate the purchases, I hope mnakumbuka how to get the cost of sales from your trading profit and loss account. From your trading profit and loss account. Cost of sales is supposed to be given by the cost of sales is supposed to be given by opening stock. Opening stock, you add purchases, then you less, you minus the closing stock like that. So to get the cost of sales, it is supposed to be given by the opening stock plus the purchases, you minus the closing stock. So cost of sales, mnakumbuka 92,000. So 92,000. Mnakumbuka the opening stock of the finished goods or inventory. It was 17, 340. So 17, 340. Then some purchases make it a question mark. Then you subtract 15, 960. So make the purchases to be the subject so that you get the value for the purchases. Make the purchases to be the subject to get the value for the purchases. Make the purchases to be the subject. Nakuja usu 96 trades. I hope online numbers are the same. Online, are you getting the same figure? So those who are online, I hope you are getting the same values that you have calculated. Are you fine? Those who are online, Muko, is that information clear? Yeah, so now after you have calculated those ratios, now I want you to answer this one here. So you start with this one. So this part is the working capital operating cycle. You check the stock turnover in this year. You add debtors collection period is that figure. And after that, I also want you to get the cash conversion operating cycle. So I want you to calculate now this year and year. Because this one, you take that plus year P. Now here P the cash conversion or operating cycle. Now you add the two, then you subtract the last one. So now get the working capital operating cycle and also the cash conversion operating cycle. Because we have calculated those figures. So compute them, then you give me the values from that arrangement. Because you have all the details now.
$92, $630. Mistakenly purchase a semicolon. $92. Ready? Yeah.
So, ile ya kwanza mnapata how many days working capital operating cycle. And the last one is 59. So online you are getting which figures? So someone is asking, where did we get 9620? 9620, I have it is written here. My formula for making the subject. I had given you that work to complete for me. So that means you are not in my class when I was explaining that part. Can you look at what I have written over here? That figure is this one here. Yes, so it is written there, do the workings, take this, that, and make that to be the subject. So don't ask where did it come from. Na iko hapo kwa board. It is here on the board. You do these workings, and we did with the people in class. Then even you are in class. Then I asked what should be that figure. All of you gave me this one. So is it clear for those who are online? Is it clear up to that point? You see, when people keep quiet, I don't know whether you are in class. Yeah. When you are away, I will not be able to get anyone. Yeah, so most of you are saying it is okay. So that was now for the non-manufacturing farm. So let us now discuss the manufacturing farm. Let us now discuss number 2 was manufacturing farms. We now got number 2 as the manufacturing farms. We got number 2 as manufacturing farms. So when it comes to the manufacturing, we summarize that the operating cycle will take into account raw materials conversion period. It will take into account the raw materials conversion period. The raw materials conversion period in days. The raw material conversion period in days, comma, work in progress, conversion period in days, work in progress conversion period in days, work in progress conversion period in days, comma, stock turnover in days, the stock turnover in days, the stock turnover in days, comma, debtors collection period in days, debtors collection period in days, the debtors collection period in days, and creditors and the creditors payment period in days, and the creditors payment period in days, and the creditors payment period in days, and the creditors payment period in days. So we simplify it now in this manner. When you want to get the cash conversion cycle, so now the cash conversion cycle, cash conversion cycle. So to prepare the cash conversion cycle, it will simply be given by the raw materials. Raw materials. Raw materials conversion period in days. Then you add, we add work in progress. Work in progress. Conversion period in days. Also add the stock turnover in days. Stock turnover in days. Stock turnover in days. Then we also add debtors collection period. Then we subtract the creditors payment period. Subtract the creditors payment period. So yes, creditors. Where raw materials conversion period in days will be given by number of days in a year. Number of days. We multiply by average stock of the raw materials. Average stock of the raw materials. Average stock of the raw materials. Then we divide by the purchases of the raw materials. Purchases of the raw materials. Then work in progress. Conversion period. Also be given by number of days in a year. Number of days. We multiply by average stock of the work in progress. Average stock of work in progress. Then we divide by usage of the raw materials. Usage of the raw materials or cost of or production costs, or simply the cost of production. Cost of production. So the other three, you already know how to compute them. The other three, the stock turnover in days, we know about it. The debtors collection period in days, we know about it. Creditors payment period in days, we also know about how to compute that. So that's now the summary for that level. I will now give you a brief illustration, which is not in your past papers, so that we use it on this area before we check a question in your past papers. Let us have an illustration. So in an illustration, we can summarize that The following information relates to M Limited. 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 So I'll simplify it this way. So I start with purchases of the raw materials. Purchases of the raw materials. So purchases for the raw materials is 700. So we write there that. So purchases of the raw materials is 6,700. It's meant to be 6,700. The next one would be usage. Usage of raw materials. Usage of the raw materials. It is 6,500. Usage of the raw materials is 6,500. The next one, now we continue in that order. The next one will be sale of the finished goods. The next one you write a sale of finished goods. Sale of the finished goods, 25,000. 25,000. The next one will be cost of sales. The next one will be the cost of sales, 18,000. Cost of sales, 18,000. The next one will be average creditors. Average creditors, 1,400. Average creditors, 1,400. The next one will be average raw material stock. Average raw material stock. Average raw material stock is 1,200. Average raw material stock is 1,200. The next one will be average work in progress stock. Average work in progress stock is 1,000. Average work in progress stock is 1,000. The next one will be average finished goods stock. Average finished stock is 2,100. Average finished goods stock is 2,100. The last one will be average debtors. Average debtors is 4,700. Average debtors is 4,700. Now required. Required is that assume there are 365 days in a year. Assume there are 365 days in a year. Assume there are 365 days in a year, comma, determine the length. Determine the length of the cash conversion cycle. 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 So let us now see how to prepare the length. So we use that formula. The formula is raw material conversion period in days. You add work in progress conversion period in days. You add the stock turnover in days. We also add debtors collection period in days. Then we minus the creditors payment period in days. So what you do, we summarize it this way. So we shall have the column for the ratio and also the formula. Also the formula which will be applying. Finally, we shall do some calculation about some calculations. We shall do try to simplify it in that manner. The ratio, the formula, then we perform some calculations. So the first one is the raw materials. Raw materials conversion. Days. So raw material conversion period days. So here we have said we assume there are how many days in a year. So you take the 365 days multiplied by the average stock, or simply the average raw materials. Average raw materials. We divide by purchases. Purchases of materials. So it will be 365 days. So what have I given here as the average stock of the raw materials? 1200. Then we started with the purchases of the raw materials. Purchases of the raw material, I gave you 60 hours. So that now should give you the raw materials conversion period in base. Give you the raw materials conversion period in base. To give you the raw material conversion period. 65 points. So the second one is supposed to be work in progress. Work in progress. Conversion period. Conversion in days. Work in progress. Conversion period. So it will be 365 days multiplied by average work in progress. Average work in progress. Then we divide by usage. Usage of the raw materials. So you also take 365 days multiplied by the average stock of the work in progress. So work in progress, I gave you 1,000. So multiplied by 1,000. So usage of the raw materials, I gave you 6,500. So divide by 6,500. So the next one should be the stock turnover in days. The third one should be the stock turnover in days. Stock turnover in days. So when it comes to the stock turnover in days, we also take the 365 days and multiplied by the average stock of the goods. Average stock of the finished goods. Average stock of the finished goods. Then we divide by the cost of sales. Cost of sales. So it is 365. The average stock of the finished goods. I gave you 2,100. So 2,100. We divide by the cost of sales. So cost of sales, I gave you here. Was it 89 or 18,000? Number 4 will be the debtors collection period. Number 4 will be debtors collection period. Debtors collection period is debtors collection period. So this one is also 365 multiplied by the average debtors, multiplied by the average debtors. Then you divide by the credit sales. So it will be 365. So multiplied by, what did I give you as the average debtors? So 47. Then you will divide by the, so we assume all the sales were on credit. Sales of the finished goods I gave you. So 25. Then number 5 is the creditors payment. Creditors payment. Creditors payment. So it will be 365 multiplied by average creditors. Then we will divide by the credit purchases. So it will be 365. So credit purchases. So the credit, the average creditors is which value? So 14. So the same purchases we have used up there. The 67 will also apply to the purchases for the raw materials still apply. So we assume all of them are on credit. But if they specify, we take the one which is on credit. But the other one we use the total purchases. But this one should only use the one which are on credit. So for this one, we assume total is the same as the one for the credit. So total will be the same as the one for the credit. So you will add the first 4, then you subtract the last one. You will add the first 4, then you subtract the last one. So at your free time, because our time is over, so you will check the question for November 2016, question 3B. November 2016, question number 3, part B. You will go through it. When we meet now in the next class, we should conclude on that question. November 2016, question 3, part B. Mtanikumbusha next time when we meet, so that we clarify some information on that question. So we can stop there. We can stop there for now.